Hello learners, welcome to our today's lesson. We are studying cost of capital. This is our second lesson. Remember, in our first lesson we only introduced. We defined cost of capital. We say that cost of capital is the price that a company pays for obtaining finance. We say that cost of capital is the price. Remember, the topic is cost of capital. Cost of capital. Cost of capital. We also refer to it as cost of finance. Cost of finance or cost of capital. It is the price that a company pays for obtaining capital. And we say that capital can be looked at from two perspectives. That is from the owner's perspective, which we refer to as equity. This is capital brought into the company by the owners, who are the shareholders, and debt. Debt represents money injected in the company by persons other than the owners. So equity, we said, can take a form of ordinary share capital, reserves, retained earnings, share premium, and so on. This debt will involve or include debentures, bonds, long-term loans, and so on. So we looked at the definition, and we also discussed the factors that determine the cost of capital. Today we want to proceed and determine or calculate. We want to learn how to calculate the various components of cost of capital. How to calculate the components of cost of capital. Remember, capital, the capital structure will involve the equity, as I've just mentioned. We may also have preferred stock or preference, share capital, and debt. Preference stock or preferred stock is a form of capital, is a source of capital. Equity is a source of capital. Debt is a source of capital. So these are components of capital. We need to learn how to calculate the cost of equity, which may be abbreviated as KE, and the cost of preference shares, which you can abbreviate as KP, and the cost of debt, we can abbreviate it as KD. So we need to learn how to determine or how to calculate cost of each component in the company's capital structure. So in the structure of the company, we may have equity, preference stock, or debt. So in our today's lesson, we'll be looking at the determination or calculation of various components of capital. So we start with the equity. Equity. How do you determine the cost of equity? How do you determine the cost of equity? Equity can be determined or can be looked at from two perspectives, okay? Or can be determined with respect to zero growth firm and constant growth firm. Zero growth firm, zero growth firm, zero growth firms, and constant growth farms. Now, as the name suggests, a zero growth farm is a farm whose dividend per share does not grow. There is zero growth. There is no growth. Okay? The dividend per share year after year does not change. It's zero. So that if year one the dividend per share is, say, 10 shillings per share, then it will remain the same for year two at 10 shillings per share. There is no growth. It's not growing. It's not growing. It's constantly at zero growth. There is no growth. Then the cost of equity can also be determined for the constant growth farms. Constant growth farm. This is a farm where the dividend per share is growing at a constant rate. For example, we may talk of 10%. 10% every year. There is is constant growth in dividend per share at the rate of 10% every year. So it's constantly growing at the rate of 10%. The first category of farm is where there is zero growth farm. There is no growth at all. There is no growth at all. So what is the cost of equity for a zero growth farm? Now, the cost of equity for a zero growth farm can be determined as follows. KE, which is cost of equity, equal to D1 over PO times 100. That is the formula for a zero growth farm where D1 is equal to the expected dividend per share, and PO is the market price per share. Market price per share, the prevailing market price per share. Then we multiply by 100 to get a percentage. So that is how you determine the cost of equity for a zero growth farm. Zero growth farm. That is the formula for a zero growth farm. And it's quite simple because this information is you are given the dividend price per share, expected price per share, and the market price, the prevailing market price per share. If it is a listed company, this is the market price at the exchange. So that is number one. The other category of farm we have said is number two, a farm that is growing at a constant growth, constant rate, constant growth farm. So what will be the dividend? What will be the cost of equity for such a farm? The cost of equity will be equal to D1 over P naught plus G plus G times 100. Convert that into percent, where D1 is equal to the expected dividend, which may also be equal to D naught times 1 plus G, which we are saying is equal to the expected dividend per share. All right? D1 is the expected dividend per share, expected dividend per share. So the formula for expected dividend per share, depending on the information that you are given, if you are appearing in exams, you may not be provided with the expected dividend per share, but you can be provided by the current dividend, okay, where D1 is equal to the current dividend, which is denoted as DO, into 1 plus G. So D0 is the current dividend. You multiply by this factor to arrive at D1, which is the expected dividend per share. And P0 is equal to the market price per share. Market price per share. Now, where a firm incurs flotation costs, remember in our introduction we talked about implicit costs. This is the cost that is incurred in the process of obtaining capital. We talked of brokerage fees, legal fees, auditing fees, and so on. Where we have the flotation costs or implicit costs, then we'll have an adjustment to this formula. We will deduct the flotation costs from the market price per share. So we have our FC there, where FC is equal to the flotation cost per share. FC is the flotation cost per share. So in the event that a company incurs flotation costs, then that flotation cost should be deducted from the market price per share. So that is how to determine the cost of equity, and KE is the cost of equity. Cost of equity. So this is the formula for the constant growth firm. And of course, G is equal to the growth rate. Growth rate, because remember we are talking about constant growth firm. So if a company is growing at a constant rate, then we'll add G, which is the growth rate. The growth rate, it may be expressed as a percentage. So that's how you determine the cost of equity, which is a component of cost of capital. So that is the formula. Then formula for equity. We have zero growth firm, constant growth firm. Number B is the cost of preference. Preference share capital. Cost of preference share capital denoted as KP should be equal to DP over PD or P naught, just have it as P naught times 100, convert that into percentage, where DP is equal to dividend per share. This DP is the expected dividend per share, and P naught is the market price per share for the preferred stock. So then you multiply that by 100. So that is the formula for the preferred stock or the preference share capital. Preference share capital. So that is the second component. That component 1 is the equity, component 2 preference share capital. Equity here, or the ordinary share capital. This equity, ordinary share capital. ordinary share capital. Then we can look at the third element. The third element is the cost of debt. The cost of debt. The cost of debt or debentures. So the cost of debt or debentures. Remember we said debt represents money brought in by parties other than the owners. Parties other than the owners. Cost of debt or debentures. Now, debenture holders, we say, and again to repeat, we say that debt will involve or include the loans, long-term loans or stock or debentures or bonds. So these bonds, the cost that the company pays, the price that the company pays will be in form of interest. So interest is paid on debt. But as for the equity and preference share capital, the cost is dividend. The dividend is the cost. But for debt, the cost is interest. So when analyzing debt, there are two categories of debt or debentures. Number one is the irredeemable debt or debentures. Then number two, we have the redeemable debt or debentures. Now the irredeemable debentures, these are also known as perpetual debentures. These debentures remain in the business until liquidation. But for the redeemable debentures, these are debentures which may be redeemed or may be bought back. They have a period. They have a period of, say, 5 years or 10 years or 20 years. So after 20 years, the debt will be redeemed. The company will give the debt holders, debenture holders, back their money, and in that case we say those are redeemable debentures. But for the irredeemable debt, this debt is perpetual. The debt is not bought back, it's not redeemed. So the formula for redeemable debentures is different from that of the irredeemable debentures. So number one, irredeemable debentures, irredeemable for the irredeemable debt. The cost of irredeemable debt, KD, will be equal to interest over VD 1 minus T. Times 100. Okay, so it will be the interest over where int is equal to the interest per debenture, VD is equal to the market value per debenture, market value per debenture. T is the corporation tax prevailing, corporation tax. T is the corporation tax, VD is the market price per debenture, and int is the interest per debenture. Remember, tax is exempt. We are talking about interest here. This interest, the debentures pay interest, which is an allowable expense for taxation purposes. The debentures pay interest, which is an allowable expense for taxation purposes. So that is the formula for irredeemable debt or perpetual debt. Then for the redeemable debentures, how do you determine the cost of redeemable debentures or debt? Now, KD, the cost of redeemable debentures, is equal to the interest plus 1 over n into m minus VD over 1 over 2 into m plus VD. So that is before tax formula. Then you apply 1 minus T. Because remember, you have said debentures pay interest, which is tax allowable, where int is equal to the interest and m is equal to the par value per debenture, the par value, the face value of the debenture. Then VD is the market price per debenture. VD is a market price, and N is a number of years to maturity, the maturity period, number of years to maturity. And of course, T is the corporation tax. So that's how to determine the cost of debt which is redeemable. So and those are the main components. Of capital. And we say this capital is obtained at a cost. So that is the formula for determining the cost of equity. And remember, we said equity comes in two categories. We have those firms that have zero growth rate and constant growth rate. Then you have the preferred share capital. We have the formula there. Then last we've looked at the cost of debt, and we have said debt, the debentures pay interest, and that the debentures can be categorized into two: irredeemable debentures or debt, which is also known as the perpetual debt, and the redeemable debt, and the formula we have given it. So now we will proceed and consider an illustration. I want to look at an illustration, and it reads as follows. The following information was extracted from the books of Faida Limited as at 31st December 2015. Ordinary share capital par value 25 shillings, 8% preferred share capital par value 24 shillings, 10% preferred share capital par value 20 shillings, and 10% debentures valued at 400,000 shillings. The value for ordinary share capital 800, the value for preferred share capital 600,000, the value for 10% preferred share capital is 400,000, and the value for debentures 400,000, giving us a total of 2.2 million. Right? That is the total value for capital. Additional information. The share prices as at 31st December 2015 were as follows. The par value, the market value for ordinary shares 30 shillings, the market price per 8% preferred shares 20 shillings, the market price per share for the 10% preferred shares 25 shillings. The market value of the 10% debenture on 31st December 2015 was 500,000. The corporation tax rate is 30%. The company, number 3, has maintained payment of ordinary dividend per share of 3.8 shillings over the past 5 years. Required. 1. Cost of ordinary share capital. Number 2, cost of 8% preference share capital. Number 3, cost of 10% preference share capital. Number 4, cost of 10% debentures. So we need to calculate the cost of every component, the cost of each and every component in that illustration. That is the question. And that can be done because all the information in the question has been provided. So what we need to do is to know, first of all, we need to know the formula for each component and the formulas we have given. Then number 2, as for the debt, we need to determine, is it a redeemable debt or is it irredeemable? So from this question, part 1 requires us to calculate the cost of share capital. Okay? Solution. Part 1 of the question, we are required to calculate the cost of ordinary shares. The cost of ordinary shares. KE. So one important thing to determine before you calculate the cost of ordinary shares KE, you need to check from the question, is this firm a zero growth firm or constant growth firm? That one should be provided, information should be provided in the question. The question should direct us as to whether the company is a zero growth firm or a constant growth firm. Now from the information here, there is no growth rate provided, which means this is a zero growth firm. And note number 3, if I'm to read it, it says that the company has maintained payment of ordinary dividend per share of 3.8 shillings over the past 5 years. So every year the company has been paying 3.8 shillings every year for the last 5 years. So there is no growth. So this is a zero growth firm, and the formula for a zero growth firm is DO or D1, expected dividend per share, over the market price per share. Market price per share, P naught. So with that, we multiply by 100 to get the rate, which is our D1 is 3.8 shillings per share, divided by the market price is provided in the table Under additional information, the market price for ordinary shares is 30 shillings. Then multiply by 100, that will give us the price. So taking my calculator, scientific, 3.8 divide 30 times 100. It's 12.67%. So this is the cost of ordinary share capital. Then part 2, what is the requirement? We are required to calculate the cost of 8% preference share capital. Cost of 8% preference share capital, preferred stock. We have two categories, the 8% preferred stock and the 10% preferred stock. These are different because the first one, the shareholders are paid a dividend of 8% per share. The second one, 10% per share. So 8%, that is K, cost of preference stock for the 8% will be equal to the dividend per share, DP over PO times 100. So what is the dividend for the 8% preferred stock? The dividend for the 8% preferred stock. The dividend is 8%. This is the dividend. This is the return that these preference shareholders are expected to earn, 8% on every stock. So 8%, and you can see that from the first table, 8% preference share capital, par value 24 shillings. Par value 24 shillings. So that is the par value. So the dividend per share will be the rate of 8% times the par value, which is 25, because remember 25 is the par value per, that is 24, not 25. 24 is the par value for the 8% preferred stock. So 8% times 24 shillings, that will be the return, the dividend per share for the preferred shareholders. Then we divide by the market price. The market price from the table under additional information, 8% preferred shares, the market price per share 20 shillings. We multiply that by 100, that will give us the rate. So taking the calculator, 8% of 24 is equal to 1.92 divided by 20. That will be equal to 0.096 times 100. The rate is 9.6%. That's how you do it. Then requirement number 3. Number 3, we have to determine the cost of 10% preference share capital, KP. So our KP here will be equal to the DP over P naught times 100. That is the formula, which is equal to, again, like in the other case, we determine the dividend per share, and the dividend, the rate paid per dividend is 10%. We multiply by the par value of the par value in the first table, the par value for 10% preferred share capital par value 20 shillings. 20 shillings. So you multiply this 10% times 20, that will give us the dividend per share. Divide that by the market price per the 10% preference share is 25 shillings. 25 shillings. Multiply the answer with 100. That will give us the cost of preferred stock. So 10% times 20 is equal to 2 shillings. Divide 2 shillings by 25. That is 0.08 times 100. The cost of preference stock here, 8%. 8%. So that's how to determine the cost of the preferred stock. Then moving on to the other part of the question, cost of debentures. Cost of debentures. The cost of debentures. Cost of debentures. That is number 4. Cost of debentures. KD. KD, again, for debentures, remember, there are 2 categories of debentures. Number 1, the perpetual debentures or the irredeemable debentures, and the redeemable debentures. Redeemable debentures have a maturity period. Irredeemable debentures are meant to be used in the company until liquidation, until the death of the company. So the formula, again, is determined by the category. For irredeemable debentures, we gave the formula. So we need to check from the question, are these debentures redeemable or irredeemable? And the only information we have here, we are told that 10% debentures amounted to 400,000. That is the par value. Then the other information provided as far as debentures is concerned is that the market value of the 10% debenture on 31st December 2016 was 500,000. So there is no information that would indicate that these are redeemable debentures. So the assumption here is that these debentures are perpetual. They are irredeemable. So the formula for irredeemable debentures is equal to the interest over VD, all right, times 100. The interest over the market price times 100. So what is the interest? What is the interest? The interest is 10%. The interest is 10%. So 10% of the par value, that will be the interest. So 10% of par value of 400,000, that will give us the interest. Then divide by the market value. The market value below the table under note 1, I read the market value of the 10% debenture on 31st December was 500,000. So we divide by 500,000. Then we multiply that by 100 to arrive at the cost of debentures. Cost of debentures. So 10% of 400,000 is equal to 40,000. That is 40,000. Divide 40,000 by 500,000. 500,000. The cost here is 0.08 times 100. That will give us 8%. But this 8% is before interest. So KD before tax, this is before tax. KD before tax is equal to 8%. But we remember we say that interest is a tax allowable expense. So KD after tax, KD after tax will be equal to interest, all right? Interest times 1 minus T. That is interest 1 minus T. The interest we have seen is 8% times 1 minus T. Tax rate provided, note number 2, 30%. So the KD after tax is 8% times 0.7, which is equal to 5.6%. 5.6%. So here, remember in our formula we had inserted 1 minus T. So after getting the interest before corporation tax, then you apply 1 minus T to get the interest after tax, which is the cost of debt after tax. So that's how to determine the cost of the various components of capital. So that is very important. So that brings us to the end of our lesson. Remember, in today's lesson, we have introduced a subtopic, which is the computation of the various components of capital, And we say that there are 3 main components of capital. That is, number 1, the components. There are 3. The first one is equity. The first component is equity. We said when analyzing the cost of equity KE, we look at it from 2 perspectives. Number 1 is the zero growth firms. Then number 2 is what we call constant growth firms. So the cost of equity for zero growth firm, KE, we have said, is equal to D1 over PO minus F times 100. That is for zero growth firm. For constant growth firm, we have said that the formula KE will be equal to the dividend per share over PO, which is the market price per share, minus flotation cost plus G, which is the growth rate, times 100, converting this into percentage. Then we have also discussed the preferred stock. This is A. B, we talked about preference share capital. Preference shares, and you say that the formula for preference shares will be equal to KP, which is equal to D1 over, that is DP over PE D or P naught times 100. So it is simple. Take the dividend per share, divide with the market price per share, multiply by 100. Then the third component that we have discussed today is the cost of debt or debentures. Cost of debt or debentures, KD. And we've said that just like equity, debentures are in two categories. We have the redeemable debentures. We have the irredeemable debentures. Number one, irredeemable debentures. Irredeemable debentures. And the formula for redeemable debentures is KD is equal to interest over VD 1 minus T. 1 minus T. That's how you determine the formula. Then we have discussed again the other category of debentures, which is the redeemable debentures. Redeemable debentures. These are debentures with a maturity period. They are expected to be bought back after a certain period, and you say that the formula is equal to KD interest plus 1 over N into M minus VD over 1 over 2 into M plus VD times this you multiply with 1 minus T. Okay, so that is how what we have learned today. That is the first formula which you need to master. So you see I have a brand blue pen. Blue pen is a brand new blue pen. That is the second formula. The third formula you need to master, need to memorize. Then we have that other formula for irredeemable debentures. And lastly, we have this formula here. You have that formula which you need also to master for redeemable debt. So that is what we have learned today. We have learned how to calculate the cost of the different components of capital. Thank you very much. I would still encourage you, advise you, a good student is one who exercises initiative, is one who reads ahead, goes back, revises what has been covered. He reads ahead, he practices questions, and that's what I recommend. Make sure you purchase our books. We have details, we have illustrations, we have revision books. Make sure you go back, read, memorize the formula. Next time we'll proceed and consider our third topic under cost of capital. Thank you.